One minute, everything's looking great. Bitcoin is right there knocking on the door of a new all-time high. And the next? Well, the next is just absolute carnage. A sudden, violent crash that sent shockwaves through the entire crypto market. So let's dive into this and try to figure out what in the world just happened.
Just like that, in what felt like the blink of an eye, Bitcoin's price just plummeted, a staggering 15% drop from its peak. For anyone watching the charts, it was just a brutal, stomach-churning moment of red everywhere.
And look, this wasn't just some number on a screen. This sell-off triggered over $20 billion in liquidations, and that's in just 24 hours. To put that in perspective, that's the single largest liquidation event in the entire history of crypto. Ever. So, the big question is, what caused this? Was it just a simple market correction, a coordinated attack, or something else entirely? To solve this mystery, we really need to dig in and look at the evidence. All right, so let's survey the scene of the crime. You've got a market in total chaos. Panic selling is rampant, billions in leverage just got wiped out, and traders are left scrambling for answers. Our investigation is going to start with the most obvious suspect. So the first trigger, the one that every news outlet was reporting on, wasn't some sophisticated hack or a system bug. Nope. It was a headline. A classic case of geopolitical news just shaking the markets to their very core. That's right. The catalyst, or at least what seemed to be the catalyst, was President Trump's announcement of new heavy tariffs on China. You know how this goes. That kind of news injects a massive dose of fear and uncertainty into the world. And in the markets, fear almost always leads to selling. And it wasn't just crypto that felt the pain. The S&P 500 also took a major dive right around the same time. This was a textbook risk-off event. That's when investors basically panic and they just sell everything that isn't seen as super safe, from stocks all the way to Bitcoin.
But here's where it gets really interesting. Because while that tariff news might have lit the fuse, a lot of experts believe the explosion was so massive because of problems buried deep within the crypto market's own plumbing.
So our second theory suggests that maybe this wasn't just a reaction to an external shock. What if it was a systemic failure from within, an inside job, so to speak, orchestrated by the market's own mechanics?
I mean, immediately after the crash, you had major industry figures, including the CEO of Crypto.com, jumping on social media and calling for an investigation. They suspected that this wasn't just a normal reaction to bad news. The sheer severity of the crash pointed to something broken, a systemic breakdown.
And that breakdown has a name: cross-margin liquidation. Now, this is a feature on a lot of exchanges. Think of it like this. If one of your big leveraged bets goes bad, the system doesn't just close that one position. It starts automatically selling your other crypto assets to cover your loss.
And this is what can create a death spiral.
So a big trader's bet on Bitcoin goes down. The system then instantly auto-sells all of their altcoin holdings to cover that loss. This, in turn, nukes the price of those altcoins, creating what traders call scam wicks, these huge sudden price drops that then trigger even more liquidations. It's a terrifying, cascading failure. Okay, so we've got two pretty compelling suspects, the White House and the exchange's own internal systems. But there's a third group of investigators out there, the ones who believe the answer was written in the charts all along.
Right, welcome to the world of technical analysis. These are the chart detectives, the folks who read the patterns of price and volume, trying to predict the future. And when they looked at this crash, they saw two very, very different stories.
First up, let's hear from the bulls. For a lot of these analysts, this savage drop wasn't just predictable, it was actually a healthy and necessary event. It was a way to flush out all the excessive leverage and reset the market for its next big move higher. So what's their evidence? Well, for one, the price bounced perfectly off a major long-term support trend line, right around $110,000, plus key trend indicators like the 21-week and 55-week moving averages, which are really just lines that show the average price over time. They held strong. For them, the long-term uptrend was still totally intact. But you knew there was a but coming, right? Of course, there's another side to this story. Other analysts looked at the exact same chart and saw flashing red lights of a much bigger problem on the horizon. For the bears, the key was the powerful rejection from that $126,000 resistance level. The price hit a brick wall, and even more importantly, the crash created what's known as a 3-day down signal. And that's a specific chart pattern that has historically shown up right before longer, much more painful market corrections.
Okay, so we've examined the crime scene, we've looked at the clues, but what does this all actually mean for the future? If we zoom out beyond the short-term chaos, there are two really powerful long-term ideas emerging that could define the next era for Bitcoin. First, you have the philosophy of the long-term believers, the accumulators. For these folks, an event like this isn't a crisis, it's an opportunity. They see all this wild volatility as just noise in a much, much larger revolution. I mean, this quote just captures it perfectly. In this worldview, Bitcoin is a totally separate financial system. So politics, short-term market crashes, all irrelevant. The one and only goal is to acquire more of the asset. A price drop is simply a discount. It's a Black Friday sale. But then there's this other fascinating new theory. It's one that points to a massive, untapped ocean of capital that has barely even touched Bitcoin yet. And if it does, it could fundamentally change the entire game. Look at that number, $34.5 trillion. That's the total value of home equity just in the United States. It's the single biggest asset class in the country. And some innovators are building a bridge from this enormous market directly into Bitcoin. The idea is basically this. New financial products could allow homeowners to access the cash value of their homes without taking on new debt. They could then use that capital to buy Bitcoin, which could potentially unleash trillions of dollars of new demand into the market. So what was it? A crash engineered by geopolitics and flawed exchange mechanics? A perfectly healthy reset that was predicted by the charts all along? You know, the truth is, it might just be all of the above. This whole event reveals a market that's both deeply connected to global events, yet it's driven by its own complex and sometimes chaotic internal logic. And maybe the real mystery isn't just what caused this one crash, but how all these powerful forces are going to continue to shape its future.